Bismillahirrahmanirrahim. This is a reading course. We plan to read through Charles Goodhart's book on the evolution of central banking. For more details, see the short link bit.ly/az2cb. The book starts by noting that there is a lot of discontent with the central bank system. It was written before the global financial crisis, after which this discontent has increased even more. So author Goodhart notes that there are two different lines of attack which are used to argue against the central banking system that we have. One line says that we should have free banking. All banks should be free and should privately create money. And this line, if you want to put it in modern terms, you can think about the Bitcoins and the Facebook lira, etc. If suppose that all the creators of money are just private entities and there are no government monies, that would be a kind of a free banking system. So it is argued on theoretical grounds that this would be superior to the current model where government central banks control the money supply. The second line is to say that central banks should follow strict rules. So in that sense, central banks don't have any autonomy. They just follow rules to fit into the economy. So again, the free market is in control of what happens. This line of thinking comes out of the rational expectation school of thought, and we will discuss that further later on. The one thing that the free market ideology does not agree with is what we call discretionary monetary policy, where the central bank looks at what's happening and then decides to take action, either increase money supply or lower it or fiddle with the interest rates according to the situation. The problem with this is that what this says is the free market does not work. And in order to make it work, the central bank has to intervene. So basically, government intervention is part of what is needed to make free markets work. And this idea is not acceptable to those who are believers in the free market. So they attack it in two different ways. Why discretionary monetary policy is harm? Well, one is the line of argument which is very familiar to economics students. This is the expectation augmented Phillips curve. According to this, suppose that the central bank increases the money supply in order to lower unemployment. Then what will happen is that eventually unemployment will come back to its natural rate, but inflation will increase. So what that policy does is, in the short term, it does cause a little bit of a reduction in unemployment, but in the long run you pay for it by higher inflation, and this thing does not last. So this is one argument which says that the central bank should not interfere with the working of the free market. The second line of attack is called the principal agent theory. According to this theory, the central bank authorities follow their own private interests. They do not follow the public interests. So the governor of the state bank is interested in his career, his salary, and so he will not do what is best for the public or the nation as a whole. So out of this line emerges the idea that we should put incentives. We should make sure that, for example, the salary of the governor of the state bank could be reduced if there is monetary instability and things like that. The third line, which is actually part of this principal agent, is called regulatory capture, where the central bank, which is supposed to regulate private banks, actually becomes an instrument of the private bank interests. So the regulator is captured by those powers that it is trying to regulate. And there is a lot of evidence that this actually has happened, that the Federal Reserve policy favors the interests of the banks instead of the interest of the public. For example, in the most recent global financial crisis, trillions of dollars of bailouts were given to banks and none to the public. So what Goodhart is telling us, that if we look at the history of banks, we don't find these, we find rather different reasons for the origins and functions. So the first thing is that the central banks were not formed to regulate money supply. Actually, the main purpose of the creation of the central banks was to provide funding to the state for wars. The central banks were created to provide loans to the state on easy terms and often to finance wars or colonizations. And they were very good at this function. So when Bank of England was formed, it enabled England to fight a war against the France very successfully. Noting this success, this idea was replicated in Europe, and many of the European nations made their own central banks in order to allow them to get good finance. And many authors, I think Peter Kennedy, Rise of Fall of Great Powers, have said that it is this ability to provide large amounts of money to fight wars that was responsible for the rise of powers. And when this ability became damaged, then the powers were lost. Another aspect of the central bank was also that with private banks you have a chaotic system of money. Every private bank issues its own notes, and there is no clear indication of which one is risky and what their values are. So the central bank can arrange to manage this. But this was not actually, this was actually done, but this was not the major function. Actually, this was also done with an eye to create revenue for the central bank and the state. So this was a side benefit, the regulation, and the main idea was just to make money. So central banks were not created for monetary policy. They were created to fund expenditures of the state, which they continue to do. The other functions evolved naturally. They were not, did not come about by design. Central banks were very large and they were politically well connected with the state, and therefore they were far safer than any other banks. As a result, commercial private banks started to rely on the central banks to keep their deposits in them and to borrow from them in times of distress. So with time, central banks became the banker's bank. But this did not happen by design. Actually, the central banks did not see themselves with this role. Rather, they saw themselves as just one big bank among the others, and they saw the other smaller bankers as competitors, initially at least. So there was an unintentional transition into central banking. Once they were established, the central banks had political power, they had gold reserves, and most importantly, they had the ability to create money by rediscounting. What is rediscounting? That is, you see, when a bank, generally speaking, the reason banks come into distress is because they give a loan to some company and they have a note from that company that I will pay you my loan on 1 year from now. Now this note is not money. So what the central bank can do is it can accept this note and say, okay, in return for this note, I will give you cash, which is what the bank needs when there is an emergency. So this is called rediscounting. So for all of these reasons, the central banks developed into a banker's bank. And when this became the banker's bank, it became possible for the central bank to make monetary policy. So this happened by evolution through a natural process. It was not by design. All right, so this is where we end this reading for today. And the passages on this slide are the ones where we end. The next time we will discuss about what is this role of management. That is a new role that central banks started to play. They had this macro management and micro management responsibilities. These will be discussed in the next session.